Hi everyone, today we are going to discuss quarterly performance of SBI. SBI reported better than estimate numbers with its Q2 profit of 945 crores. This was against the street estimate of a loss in Q2. The profit in the quarter was mainly aided by one-off gain from the stake sale in general insurance business and also due to lower provisions. The key highlight of this quarter's performance was the improvement in asset quality. The decline in the watch list as well as the lower slippages to the non-performing assets was very comforting. So while the asset quality pain may persist for a couple of more quarters, we anticipate the credit cost to significantly decline over the next 2 years. Earnings will gain traction as the credit cost normalizes and bank levers its capital for further growth. So let's look at the key highlights of its Q2 performance. SBI reported a healthy NII growth, which is net interest income growth of almost 12% on a year-on-year basis. This was mainly aided by the strong growth in loan book as well as uptick in margins. Bank's net interest margins improved to almost 2.88%, and this was also because of write-back of interest income due to resolution of certain NCLT cases in Q1. Bank's operating expenses increased by almost 12% on a year-on-year basis, pushing cost-to-income ratio to 58% as compared to 56% last year. This was again because of the higher staff cost and bank provided for increase in the wage income. Bank's loan book growth was very good and it came in at around 9% on a year-on-year basis. Domestic growth was even better at 11% as corporate loan book grew by 14% and retail loan book grew by 9% on a year-on-year basis. The key highlight of SBI's performance in Q2 was the improvement in asset quality. Slippages to non-performing assets at around 10,800 crore was very contained and better as compared to the last quarter. The slippages were around 2% of its loan book. Because of the lower slippages and also because of upgradation and recoveries, we saw a sequential decline in the gross NPA ratio. Also, the watch list, which is nothing but the stress asset loan book of the bank, which also declined on a sequential basis from around 24,000 crore to 20,000 crore, and again was very comforting. Bank's provision coverage ratio stands at around 71% and it stands to gain from further resolution of any NCLT cases. The bank has already indicated that it anticipates a 6,000 crore of write back from the resolution of SR Steel account. So what's the outlook on this stock? SBI stands out for its dominant market position and also better operating performance as compared to many other public sector banks which are fast losing relevance in the financial system. We anticipate a faster recovery for SBI as compared to many other public sector banks. While FY19 may remain a year of consolidation because of higher credit cost, we anticipate a significant improvement in return ratios from FY20 onwards. Management has already articulated its strategy and has targeted certain return ratios for March 2020. It aims to achieve a return on asset of almost 1% while improving the gross non-performing asset to below 6% and maintaining the provision coverage ratio at 60%. With the credit cost declining and slippages being contained at 2%, the target looks achievable. Given the improvement in return ratios, the current valuation of the stock looks undemanding. The stock is trading at 1.1 times FY20 adjusted book. So the investors who are looking to play the asset recovery and resolution cycle should buy the stock from a long-term perspective. That's it from my side. For more stock updates and research, please log on to moneycontrol.com.